Good afternoon, everybody. My name is Andrew Schaefer. Welcome to the May webinar. The topic we're covering today are the principles of financial management for community schemes. We're going to start punctually at 5 and aim to finish punctually by 6 o'clock. Joining me tonight on the webinar are my colleagues Karine Coetzee, Trafalgar's National Property Management Consultant. We have Samuel Nicholson, Trafalgar's National Accounting Manager, and Yolisa Gyasi, who is a tax practitioner and has recently joined Trafalgar about a month or two ago. So tonight's topic is not one that's absolutely comfortable for many of our clients and trustees, particularly those that aren't directly involved in financial management. So it can be a topic which is, quite unfamiliar, let's say. It also takes time to review financial reports on a monthly basis and be informed on the financial transactions for a community scheme. Nevertheless, it's critically important because a community scheme, whether it's a sectional title body corporate, a homeowners association, or even a share block, it's a legal entity. It has cash flows, and for sustainability purposes, for service delivery, etc., effective financial management is fundamental to the long-term success of the community scheme. So it really is an important topic. We are going to try and present the topics we're going to cover in a practical way, in a non-technical, non-jargon way, just to make it, approachable and accessible. Our contact details will be available at the end, so any of us are certainly available to, chat to you further about specific circumstances or specific challenges which might exist, which go beyond the scope of the webinar today. But at least we'd like to cover some general principles and best practice, which we hope will be of interest. As usual, we're recording this webinar so that it can be used as a training guide. It will be loaded onto our training platform. And a reminder that all of our training webinars we've offered over the last 3 years are loaded on training.trafalgar.co.za. /webinars. For the webinars, you will find extensive free training material covering everything related to community schemes, for trustees, directors, owners, etc. They're interesting questions of the week, which cover, a range of topical and important questions. And the whole idea is to share information, provide training, and help, owners and trustees and directors be more informed about their roles in the management of community schemes. Please do load any questions in the Q&A. Karine and I will endeavor to answer those. If we don't complete answering, we will come back to you afterwards. A recording link will be circulated to all those who've registered, so we can allow those who couldn't make it at short notice have access, and we will also circulate the slides as a reference guide. Please delete if you don't want to keep those, and the materials will be available on the training website, as I mentioned. A short Q&A pop-up or survey will pop up at the end for those that would like to leave feedback on how you found the webinar, and in particular to suggest any topics that you would like us to cover going forward. We would appreciate your feedback on the survey, and it certainly won't take more than 30 seconds to complete. So thanks very much for everyone joining us tonight. And I'm going to hand over first to my colleague Karine Coetzee, who will start as usual with a recap of the legislation, and in particular legislation pertaining to the financial management requirements for community schemes. Karine, over to you.
Thanks, Andrew. So let's look at financial management for sectional title schemes first. There's basically a couple of things in the Sectional Title Schemes Management Act that applies to these schemes. The one being to operate two funds. This is a new requirement since October 2016. Not so new anymore, but still new to some people, that you have to have an administrative fund to cover the operating expenses and a reserve fund to cover planned maintenance expenses in terms of the 10-year maintenance plan. You also need to have budgets for these two funds that is approved at the general meeting by majority of the owners. In other words, an ordinary resolution, which is a majority of vote based on the PQs of the sections. And then we sometimes get queries from clients that, with regards to different schemes. I pay a levy of 1,000 Rand. Why does the neighboring scheme only pay a levy of 200 Rand? So the expenses differ from scheme to scheme. It is determined by the budget of the specific scheme. And the income of these schemes are mainly derived from raising levies. So you have an admin fund levy, you've got a reserve fund levy. Sometimes the trustees have to raise special levies for special projects. And if there's exclusive use areas, then there will sometimes be an exclusive use levy as well. If we just look at audit, that will be a big topic tonight. Since the Act changed from 7 October 2016, the default financial year of schemes that were registered after that date is September. Previously it was February, now it is for new schemes September, but you only need an ordinary resolution, as I said, a majority decision by the owners to change your financial year end. You don't have to keep it on September, or if it's still February as per the old Act, you can change that. You don't have to keep it on that specific month. It is just a default for newly registered schemes. The financial statements are to be audited and presented to the owners every year. And just a note that financial statements, or Fs as we call it, are not approved at the annual general meeting. They're only considered if you look at the prescribed agenda of an annual general meeting of a body corporate. And then just lastly, the note that in the previous Act, there was the option of an accounting officer instead of an auditor for smaller schemes. That has been removed by the Sectional Title Schemes Management Act. That, as I said, came into being on 7 October 2016. So now I would like to hand over to my colleague Samuel. Thank you.
Thank you, Corinne. Good evening, everybody, and thank you for joining us today. My name is Samuel Nicholson, and I'm here to give you some insights into what an audit involves, why it's important, and how to make it work smoothly for your scheme. Let's begin by exploring why audits are essential. Audits are not just a box-ticking exercise. They are legal requirements under the PMR, as Karina said. But more importantly, they play a critical role in ensuring transparency and accountability give everyone confidence in the financial reporting and form the basis for sound decision-making by trustees. From a governance point of view, audits also serve as a protective mechanism for trustees, showing that funds have been managed with care and oversight. Next slide, please, Corinne. So how does the audit process work? At Trafalgar, we manage this process from end to end. It begins with the appointment of an auditor, and we assist by sourcing 3 competitive quotes from independent registered professionals. Once the auditor is selected, our accountants prepare a comprehensive audit file guided by a complete checklist. This includes all financial documentation for the communication. This structured handover helps prevent delays and keeps the process efficient. The auditor then performs a detailed testing of records, verifying accuracy, checking compliance, and raising any queries for clarification. Next slide, please, Corinne. When the auditor completes their initial review, they produce a first draft of the annual financial statements. At this stage, Trafalgar carries out an internal review. We cross-check the opening and closing balances, scrutinize any audit adjustments, verify tax calculations, and ensure that the scheme's executive information is correct. The final draft is then submitted to the scheme executors for their review and approval. An additional step we take is conducting an auditor survey review. This allows auditors to provide feedback on the audit process, helping us identify any challenges or bottlenecks and improve audit readiness for the next one. Next slide, please, Corinne. Let me give you a practical idea of what's included in an audit file. This here is our audit file checklist. As you can see, you'll find a full trial balance and ledger reports, bank statements, reconciliations, levy schedules, debtor and creditor listings, and the list goes on and on. Next slide, please, Corinne. Since this is an exhaustive list, we also prepare commentary on every line item as to why it may not be applicable to the specific audit. This in turn helps the auditor to paint a clear picture as to what kind of scheme they are auditing, ensuring efficiency on all slides. Next slide, please, Corinne. A well-prepared audit file is key to reducing queries and speeding up the audit process. Let's now clarify who plays what role in the audit process. First, the managing agent. Trafalgar, in this case, prepares the audit file and oversees the entire process from beginning to end. Then we have the trustees. Their role includes reviewing the final monthly report for the year, confirming write-off recommendations from the auditor, and signing the final AFS and engagement letter. Next are the owners. While they don't approve the financial statements, they do receive and review the audited financials at the AGM. This promotes transparency and awareness of how levies and funds are being used. Finally, there is the auditor, who must be independent and registered with the IRBA, Independent Regulatory Board of Auditors. Their responsibility is to evaluate the financials and issue an audit opinion. And speaking of audit opinions, these are issued by the auditor as feedback after reviewing the scheme's finances. There are 4 types of audit opinions, and it's important to understand what each one means. First is the unqualified. This is the best outcome. It means the financials are accurate and are presented honestly. Then we have the qualified opinion. This means that there are some issues, such as missing documentation, but the financials are still largely reliable. An adverse opinion. This is serious. It indicates that the financial statements are materially misstated and are unreliable, meaning there are big problems with the financials and the numbers cannot be trusted. And lastly, the disclaimer of opinion. This occurs when an auditor wasn't given enough information to conduct the audit. An example of this being if bookkeeping was unorganized and the key documentation is missing. Essentially, the auditor doesn't know if the numbers are right or wrong and can't advise us on it either. A scheme should always strive for an unqualified audit opinion, as it reflects good governance and solid financial practices. Next slide, please, Corinne. Now let's discuss the audit timelines, a critical part of staying compliant and avoiding delays. The recommendation is that the final draft of the audited financial statements are submitted to the trustees or directors within 2 months of the financial year end. In order to meet this kind of deadline, the final month's financial report is prepared within 10 working days after financial year end. Thereafter, another 10 working days are used to compile and submit the audit file. The audit itself typically takes around 3 weeks to complete. Once that is done, Trafalgar of the first draft. And finally, the final version is submitted to the trustees or directors for review and signature. All of this is expected within 2 months of the financial year. Following this kind of timeline helps us ensure that the audit is completed well in advance of the AGM and gives all parties enough time for a thorough review. So just to wrap up on my presentation, audits are a legal requirement and a vital tool for maintaining transparency, trust, and accountability in the scheme. Trafalgar manages the audit process from start to finish, from appointing an auditor to reviewing the final financials. All parties, being the managing agents, trustees, auditors, and owners, have important roles to play in ensuring the audit is successful. The goal is always to achieve an unqualified audit opinion, a clear indicator of sound financial management. And finally, sticking to the audit timeline helps avoid unnecessary delays and ensures compliance. Thank you for your time. I'll hand over to Lisa to take us through the tax portion.
Thank you so much, Samuel. Unfortunately, I have the unfortunate luck of talking about taxes, which is, I think, everyone's least favorite thing to talk about, but it is unfortunately an unnecessary evil. Thank you for all of you who are able to join us this evening. I will be covering 5 key aspects that we would need to consider when we talk about tax compliance for a scheme like a body corporate share block or HOA. Firstly, we'll be touching on the importance of a public officer. We'll be looking at some of the requirements and implications for income tax purposes. We'll touch on the VAT and the pay-as-you-earn requirements, as well as the importance of general tax compliance. Next screen, please, Corinne. Now, some of you may or may not have received multiple emails from us regarding a public officer, and you're asking yourself, why is it so important for us to have a public officer? Now, this is a legal requirement, and prior to 2020, although the requirement was always there, it wasn't enforced as much as it is currently by SARS. Now, any juristic person, which is a non-natural person, must have a public officer, which is a natural person who resides in South Africa, who represents that company. Now, that person acts as the main contact person with SARS on all tax-related issues. Now, whether it is the registration of new tax types, whether it's the submission of tax returns after the audit files have been completed, whether it's the making of the payments or just liaising with SARS in terms of audits, SARS always looks to the public officer to engage or the registered tax practitioner, and not necessarily the scheme itself, because the scheme is not a natural person. So there must always be a natural person at all times who is available to answer questions to SARS. Now, the question may be, why do we always want a centralized person who, and for continuity purposes, the same person? Trustees may change at any AGM as good corporate governance dictates, but SARS could audit a tax return 5 years from now. It's important that a person who was there 5 years ago be available to answer any questions that SARS may raise. It is for this reason, for instance, you would appoint Trafalgar as a public officer, knowing that even though there are changes in your trustees and in your board, Trafalgar is the main contact person and can engage with SARS on any tax-related issue should the need arise. There's also then the requirement to update any changes within 21 business days. So if you have, for instance, have appointed a trustee, within 21 days after that trustee has ceased to be a trustee, we need to appoint someone else to make sure that there's continuity with SARS, because if any point that those records are not up to date, we could suffer some sort of penalties in terms of SARS. Next slide, please, Karine. Now, it's good and well that we keep our schemes financially afloat, but there is consideration from an income tax perspective as well. All those levies that Karine had mentioned earlier in her presentation by law are considered exempt income, and that basically means that it does not attract any income tax. This includes your reserve fund levies, your special levies, your CSOS levies, all of those, because they are seen to be monies that are collected for the management of the broader scheme, the day-to-day scheme. So it does not attract any income. Or income tax rather. However, there are certain incomes that a HOA, particularly more than body corporates, can generate, and there is a consideration for tax. For instance, if you are raising interest on levies, the late payment of levies, or you have a clubhouse that you are renting out, or even rendering services like you have a little laundromat or a restaurant on the premises, you need to consider the tax implications and make provisions for that. While there is a basic exemption, and this means that the first 50,000 Rand is tax-free and everything after that is taxable, it is important when you review those financials, like Samuel has mentioned, that you keep an eye out for that type of income, because when we do the taxes, then it's important that that money is available to pay it over to SARS. Next slide, please, Karine. Now, the VAT works pretty similar to the income tax. The same way the income tax levies are exempt, they are exempt for VAT purposes as well. And this is just a snippet from the VAT Act. It's very technical, but we're not going to get much into that. What it basically says is that we're not actually producing any sort of business. There's no enterprise. Therefore, the levies that we're collecting do not attract any VAT, and no VAT is payable on that. This is body corporate, share block companies, housing development schemes for retired persons, as well as homeowners associations. And homeowners associations were only included in 2014, and prior to that, their levies were taxable, or they were seen as standard rated supplies, but not anymore, because they work similar to body corporates. So if you have those types of supplies, you do not register for VAT. However, if you have the other income, then you need to consider VAT as well. Next slide, please, Karine. And what is that consideration? The consideration is that if you're making more than R1 million in these other, what we call standard rated supplies, you are required by law to register your scheme for VAT. You could also then decide that you'd like to a voluntary registration because you haven't met the threshold of R1 million, but you do meet a 50,000 Rand and want to benefit from the input taxes that you pay when you're procuring your services. You also need to consider, are you actually procuring your services from other VAT vendors? Because if you're not, and you're still a VAT vendor, you'll just be paying over to SARS every month without any benefit. Also, you need to consider the administrative work that comes with it. VAT returns may be submitted every 2 months. It's not like income tax where you submit once a year. So before you decide that, listen, we've met the 50,000 Rand threshold and we want to register for VAT, actually consider and speak to us. I am a registered tax practitioner, and we are able to advise you on whether or not it's actually beneficial for your scheme to register for VAT, or you should just leave it as it is because you'll end up paying more taxes without any benefit. So if this 12-month that we speak of is any consecutive 12 months. It has nothing to do with the year of assessment. So if you're thinking you have a February year end, and so I'm looking from March to Feb, that's not how it works. It's a rolling period of any 12 months that SARS considers. Next slide, please, Karine. Now, when it comes to pay-as-you-earn or employees tax, the benefit or the exemptions that exist for income tax and for VAT don't exist for pay-as-you-earn. As long as you have any sort of employee, be it an estate manager or a caretaker, you've insourced some gardeners, you've insourced some cleaners, you have a financial manager, even if it's one employee, you are required to register as an employee for pay-as-you-earn with SARS. So you register for pay-as-you-earn as well as UIF. If your payroll exceeds 500,000 Rand in the year, you're also required to register for STL. But you also have to register with a compensation fund for workmen's compensation. So there are many considerations because now your scheme has become an employer and needs to comply with the employee or the employer laws of the country. So much like you strive to have a tax clearance for tax, you also need a letter of good standing from Department of Labor the moment you become an employer. Next slide, please, Karine. Now, what is the importance of general tax compliance? Let's look for HOAs, for example. Unlike body corporates and share block companies, HOAs must apply for tax exemption with SARS. Body corporates and share blocks are automatically considered as tax exempt, but SARS will not grant you the tax exemption if you have a history of non-compliance. You must be good to SARS for SARS to be good to you. Now, again, your ability to register for the relevant taxes. Like I said, as soon as you become an employer, you must register for employees tax. As soon as you meet the R1 million threshold, you must register for VAT. If you are non-compliant with income tax, already SARS sees that you are unable to meet your legal obligations as they arise, and they could refuse to register you for VAT. And then by the time you register, they are backdating it with interest and penalties. So you must make sure that at any given point in time, your scheme is up to date and is tax compliant, because it could affect their legal ability to register for taxes as and when required. Again, we know that hardships do happen. Sometimes the scheme didn't budget for the taxes that came with all the additional income. Maybe they're not liquid enough to pay 100,000 Rand all in one go. So they need to enter a payment arrangement. SARS will not consider those types of things if you have a demonstrated history of non-compliance, because they're basically saying, how do we know that you're going to keep up your end of the deal when you haven't done so in the past? Some schemes are insolvent and they may need to have a debt compromise. SARS considers the type of taxpayer your scheme has been in the past to determine whether or not they want to be good to you going forward. And by continuous compliance, we mean that you need to be compliant throughout, even if you can rectify your non-compliance at a given point. If you were non-compliant in 2001, and then you were non-compliant in 2010, and then you were non-compliant again in 2014, it means that you have several bouts of non-compliance, and SARS considers that. You want to be compliant throughout your scheme's tax life, basically, if we can put it that way, to make sure that SARS views you as the model taxpayer, so that when you need SARS to be good to you, they come to the party. In essence. So I think that would cover the taxes. I've tried to make a very painful topic as least painful as possible. Thank you so much, and over to you, Andrew.
Thank you, Yolisa. I think at this stage, let's just pause for one or two questions that have come up on these topics, and we'll get to the management reports thereafter. Yolisa, can you just comment on the opportunity to get a tax compliance certificate once a year, perhaps once the audited financials are signed, as a double check that the tax obligations of a community scheme are correctly up to date, and that would be a quality assurance to the trustees or the directors that this element of their financial management is being well managed.
No, 100%. It's always good when, especially as trustees, to play open cards with your members. At the end of the day, it becomes very difficult when you're handling members' monies, and members want to know that they're actually being used correctly and everything is done the correct way. So what would happen then, as soon as the financials are signed, that is when we submit the tax returns and the taxes are paid. I think it is a good practice that after that process has been completed, we then send the tax clearance PIN, because now it's no longer necessarily a certificate, but it is a PIN that at any given point in time within a year, the compliance of that scheme can be checked. So it is important for both trustees and the members not to be idle and to be active in their schemes to check that type of documentation.
Thank you. And in the audited financials, Yolisa, the auditors are only checking income tax as one of the tax elements. They wouldn't necessarily check compliance with the other taxes and those being paid up to date with SARS. Is that correct?
Maybe Sam would be best with that, because again, I'm not sure what auditors are looking at. I know from the audits that I've been part of in the past, they would actually look to say, please send your VAT control account. We need to see, have you been up to date with your VAT and all of that. So they do look at the VAT as well. I haven't seen auditors look at the pay as you earn aspect as closely, but the VAT I do think is a consideration.
Okay, thank you. Samuel, well, let's ask you that question then, just in terms of what is the scope of an audit related to the taxes that we've spoken about now?
They mostly do the sample testing to make sure that we are compliant with the prior years to the current years, but it's not necessarily a full thorough calculation that's done, as we still need to reconfirm what they have done based off the template that they use.
Yeah. There was a question on the Q&A just about year ends. So, my experience is that more than 50% of schemes have a February year end, which was a default at the time of those schemes being registered. And, the challenge with that is that, auditors are literally overwhelmed with February year ends, based on community schemes, but all the other work that they do. So what happens then is they get backlogged. There's a huge volume of workload to get through in a short space of time. And, more often than not, the audits are delayed and there's just a long period of time to get them finalized. And that obviously puts pressure on the timing of the AGM. What I've found is if the AGM, if the year end can be moved by ordinary resolution, as Karine said, to a different month, and we're going to ask Samuel which are better months to choose. Number one, it can be then timed in a month which is less busy, so the audit can be completed more quickly. And there are certain auditors that would discount audit fees if the audits were at times in the year which are less busy than a February year end. So Samuel, would you mind commenting on that?
Yeah, generally the best year ends to have is between July and August, between the February and September year ends, because that's when things are most quiet. By July, most of the February year ends are audited and finalized. So things quieten down for them between July and August. Otherwise, December and January is also a great year end to have.
Great. Then, just with audited financials, we have many trustee clients and directors that, really don't work with audited financials as their core business. They don't have experience, and therefore they're not particularly comfortable with their responsibilities to review and approve and sign off the audited financials. Nevertheless, that is the expectation of the legislation, that there are going to be 2 trustees or 2 directors that sign off the audit, which is then presented for review and consideration at the AGM. We also have the complication, Samuel, where we have new trustees or directors who are then asked to sign historical financial statements from time periods before where they were involved, for whatever reason. And many of them feel uncomfortable doing it because they weren't involved in any way in the scheme's management or in a capacity as a trustee or director. So what guidance or what input would you give to trustees and directors to be comfortable to fulfill that duty, to go through the draft financials and thereafter to approve and sign them off, so that this governance cycle can continue?
Andrew, that's quite a difficult question for me to answer. It's unfortunately, I do lack the experience in that side. I haven't come across a specific audit or set of financials where the trustees have refused to sign. But what I've seen in other instances is that the trustees have gone to the previous board who were trustees at the time and requested them to sign and take it through to CSOS for in order to be put through that they make signature of it, because they were the board of trustees at the time. So that's the main advice I can give on that.
Yeah. All right. Perhaps I will say that, it's important just for, trustees and directors to be aware that, our accountants, will be checking the draft financials that they agree to the management reports. So there definitely is a checking function on our side to make sure we're happy the drafts are accurate before they are forwarded to trustees and directors for review and approval. Where there are queries, our team are certainly available to work through those queries, to provide further information in terms of vouchers or ledger reports, etc. And certain auditors would also make themselves available to meet to discuss certain queries and concerns. So those factors should all be taken into account. It's also important to note that there is a governance timetable which is underlying financial management. For example, for sectional title schemes, the legislation prescribes 4 months as the timing by which an annual general meeting should be convened after the year end. Now, because the signed audited financial statements are a part of the AGM agenda, it's therefore important that the whole timing of the audit program is set up to be completed and available for the AGM to be conducted on time. And so that's why I raised the point of the February ends can stress that timing, because of the auditor's workload capacity constraints. And secondly, if there are queries which cause delays, those do need to be tackled in a prioritized way, because if they're not, again, it puts pressure on the timing of an AGM. And I think certainly the schemes with good governance and effective financial management do achieve their audits being on time, their AGMs being on time, and being able to consistently achieve that, which is a very good signal to all the owners and bondholders as well, that financial management is well managed for that particular scheme. So that's really important. We do get cases where the trustees, or directors remain uncomfortable. And in those cases, it might be necessary to convene the AGM without signed financials and to really ask the body corporate or the homeowners for a resolution, then to approve the financials collectively so that the process can move forward. That isn't standard practice. It isn't absolutely prescribed in that way, but there are practicalities to bypass difficulties if they arise in that way. Karine, are there any questions you'd like to raise to Samuel or Yolisa before I continue?
No, thanks, Andrew. You can continue.
Okay, thank you. All right, so we've got about 20 minutes, 20 to 25 minutes. I'd like to just quickly review the monthly management reports which we provide, but most managing agents would provide a monthly financial management report to the trustees and directors, which really gives a good overview of the financial transactions, the financial performance, and the financial status of their schemes. Now, as I said at the beginning, this is onerous to certain people that aren't familiar or comfortable with financial reports, but nevertheless, it remains crucially important because it is the dashboard, the financial dashboard, which gives the, health indication of the scheme in terms of cash flow, debtors, creditors, all the financial, topics you might have heard of, which are important to monitor and to be aware of. And, my recommendation based on experience is that, it would be ideal that at least the chairman and at least a financial director or trustee take the responsibility to review monthly management reports each and every month on a consistent basis, and to allocate 10 to 15 minutes to doing that. And, as I'll show you now, the reports are reasonably self-explanatory, I think, but certainly the portfolio team or the accountant would be more than willing to set up a meeting, ideally online, to work through the sample report and to explain the format, to go through any questions, and to try and demystify it as far as possible. Because, once that is done, it makes further monthly reviews that much easier. And certainly those people will always be available if any questions arise. If there are queries or concerns or gaps, it's important that those should be raised very quickly, to be checked and to be corrected. Errors unfortunately do happen, but that's certainly important. And if monthly management reporting is undertaken consistently, it does make the year-end audit file that much simpler and quicker to compile, because it really constitutes a build-up of all the monthly management reports. Karine, if I can ask you to stop sharing, and then I will just share from my side the sample report, and I'll just take everyone through it from my side. So, speaking from a Trafalgar example, we circulate monthly management reports. Karine, sorry, I'm just battling to find my file. Perhaps I'll just send it to you by email and you could do that. So Trafalgar circulates monthly management reports around about the 15th to the 20th of each month. So for example, now in May, the middle of May, we would be reporting the management report from April, meaning it's been checked by the accountant, and they are then comfortable to circulate it to the trustees. Again, their contact details will be available, so they are able to answer any questions or queries which might arise then and there. The whole point about the monthly management report is to give full transparency to all the levy collections for the prior month, the outstanding debtors and what is being done to collect that arrear levy debt by the debt collection team, which creditors have been paid on behalf of the body corporate. And our new system actually links the invoices for all the creditor payments into the pack, so it can be drilled down to see the full invoice details for the creditor payments. It then presents that information in an income statement showing by month in the current financial year all the income transactions as well as the expense transactions and how those compare to budget. And it's a strong recommendation that the trustees and directors focus very carefully on what are the variances to budget, and are those variances, understood, and are they correct? Because clearly it indicates that there was an error or there was some, forecasting, mismatch in terms of the costs coming through. And if that obviously continues, it can stress the levy budget, because the levies are typically configured to cover the costs, the forecast costs of the community scheme through the financial year. So that's there. The detailed balance sheet is also included in the monthly management report, and that really gives a very clear breakdown of all the important items: cash balances, debtors, creditors, and reserves, which are all important information elements for trustees and directors to be aware of. Again, this is the dashboard of the financial health of the community scheme, and most certainly, if it's well managed, it provides a foundation for the continuity of service delivery at a community scheme. And we see time and again where the finances are not well managed, or they're not well understood by the trustees and directors, it can cause certainly complications with cash flow, and unfortunately the vicious circle of poor cash flow leading to delayed municipal payments or delayed maintenance implemented at a body corporate. It can slowly snowball into a scheme which doesn't look good. They're interrupted municipal services. Maintenance becomes more and more expensive because it is not implemented at the correct period of time. And, a stitch in time saves nine is a very sort of relevant and apt term in terms of delayed maintenance at a particular property. As Karine said, best practice certainly for all types of schemes, but in sectional title it's legislated that a reserve fund needs to be developed based on reserve levies to start planning for preventative maintenance. So schemes are required to present a 10-year maintenance plan for approval at the AGM, and there are reserve fund levies that are linked to the different maintenance projects, so that the community scheme is saving progressively to be able to implement maintenance at the correct point in time over a longer period of 10 years, so that it can be afforded, it can be done at the right time, and really trying to maintain the property to a higher degree of standard and aesthetics over a longer period of time. And that's really what retains and enhances value in a property, that it is well maintained, it's well presented, it meets the needs and expectations of the residents. Banks are also reported financial statements. Bondholders do expect managing agents or parties managing the financial affairs to report the audited financials to them. And when they're looking at bond applications in a particular scheme, they would be looking for the financial statements of that scheme to evaluate the risk to them as a bondholder for having credit risk in that particular property. And certainly where the financial health and well-being of a community scheme deteriorates, there would be red flags for banks, and that's going to start reducing their appetite to grant bonds, which naturally will decrease property values, because it becomes harder and harder for property buyers to be able to finance their acquisitions in a particular project. A particular scheme. So really what I'm saying is, financial management and financial governance is at the heart of effective and responsible property management, and in particular for trustees and directors that now hold fiduciary responsibilities for managing and taking decisions on behalf of the owners in these schemes. And, certainly with the right input and help from the portfolio team, from the accountants that are assigned to working with these community schemes, they would be able to become comfortable with the financial processes which apply, with the presentation of the financial reports, as well as with the audited financial statements. Now, naturally, property managers and auditors work on different systems. They therefore have different formats and different presentations, but certainly the underlying core information remains the same. And, with a bit of time and support as required, it can be demystified and become, reasonably practical to work through the important details and to be informed of all the important and relevant, financial elements that remain there. It's important also to know that CSOS, which is the Community Scheme Ombud Service, does require an annual return to be lodged with them for each and every community scheme in South Africa. They're obviously pushing very hard for all community schemes to be registered, because if they are registered on their system, they can then track that those annual returns are lodged with them. Now, part and parcel of those annual returns is the audited financial statements being completed and signed, the AGM being completed, and therefore the budget and the levy schedule being finalized. And that annual return to CSOS then requires the AGM minutes as well as the levy schedule to be lodged with CSOS, because that's how they can see what CSOS levies they are expecting, and therefore they can track that and make sure they are getting their income required, which subsidizes the role they play in terms of approving conduct rules, in terms of mediating as well as adjudicating disputes. So the reason I raise this is because you can see again there is another governance and regulatory step linked to the audit, which is linked to the annual general meeting, and that sort of reporting to follow to a very important regulator in the community scheme space, which applies to all types of community schemes, as we come across. What's really important as well is just approving creditor payments. So, the income of the body corporate, which is really the levies, as Yulisa said, and there are some additional income streams of which Yulisa mentioned some, that is a reasonably, let's call it constrained income stream, because very often the budgets for community schemes start with what are the forecast expenses, based on the prior year and based on projects which are expected. And the levy income is set really to match expenses plus a small surplus. So it really is a very small surplus, and many schemes are very much focused on minimizing levy increases. Now, if there are levy arrears in a scheme and certain owners are not paying, that naturally stresses the cash flow in a scheme, because it is not then achieving the levy income which is budgeted to cover the expenses. And particularly in small or small medium schemes, that can cause serious cash flow challenges to maintain service delivery and maintenance. And bigger schemes are able to cross-subsidize a bit better, but the smaller schemes will struggle if there are levy arrears. So it does need to be taken into account with budgeting that there are challenges with cash flow if there are levy arrears, and that should be analyzed with the budgeting to see if a bigger surplus and a larger levy increase might be required. Yulisa, please come in.
Yes, I just had a question on that point, Andrew, as to what extent can a poor financial management of the scheme have an impact on the property value within that scheme? And this is more like homeowners associations, where you know that you have the individual property, it's not necessarily shared, but because of where it is located and the how poorly it is managed, how does that then affect the property value of the properties within that scheme?
So Yulisa, it most certainly will, but typically over a medium to longer term. And what typically happens is that, it takes time, but it's really the poor financial management will lead to slow deterioration of the ability to pay, number one, municipal accounts, which tend to be around about 50% of the expense in a community scheme. So rates, electricity, water, domestic effluent. And I think everybody's seeing that these costs are being increased year on year by well more than inflation, because municipalities around the country tend to be under financial pressure. So as levy arrears might accumulate, or if costs are exceeding budgeted expectations, the ability of a scheme to meet their maintenance and municipal costs becomes under pressure. And a point in time can arise where, the municipal account cannot be paid in full. And then penalty, interest, and fees are then raised on the account, and slowly the vicious circle continues.
Yeah.
Shortcuts can be taken with maintenance, and maintenance, like many things, will accelerate in terms of cost, because peeling paint can become spalling concrete and steelwork, and that becomes more expensive to maintain. So what happens over time is that the complex starts looking worse and worse. There aren't funds to take care of the gardens and the grounds and the light bulbs and the leaking taps, etc. So potential buyers that now come into the scheme to look at units for sale are going to start seeing that it doesn't look good. There appear to be maintenance problems. It doesn't look well maintained. Facility management is below standard, and these first impressions count.
Yeah.
And all of a sudden that starts eroding interest. It starts therefore eroding value. There are less and less buyers that are willing to look at a scheme. Therefore, it becomes harder and harder to sell. Sellers need to discount their pricing to make the properties more interesting. And again, like I said, the banks are also looking at the financial reports, in particular the signed off audited financials, to decide whether they want to entertain bond applications in a particular community scheme. And if they start so-called redlining or excluding certain areas or certain buildings from bond finance, it also cuts out a large part of the market in terms of potential buyers, and that will tip the supply and demand sort of equation in terms of interest into a scheme. So that tends to be the sort of, the unfortunate life cycle or vicious circle in terms of how poor financial management and cash flow plays out in property values. And considering the asset value of properties to most owners and the significance of that, it obviously makes sense that these properties are well managed financially, that there are informed people taking a role and responsibility in monitoring the financial reports, in approving financial expenses for the building, in making sure that the budget is accurate, and in making sure that the audit is undertaken in a compliant and responsible way each and every year. And gaps and shortcuts should not be allowed, because it becomes harder and harder over time to fix these and to make sure that they are corrected, which then becomes the responsibility of the next set of trustees or directors, which is unfair on them because they wouldn't have the background or the direct exposure to what happened at the time.
And just to caveat on that, then what then happens if at some point no one puts their hand up to become the trustee? Because I can imagine if something has deteriorated long enough, no one wants to touch it with a 10-foot pole. What then happens to the scheme that finds itself in that position?
Yeah, so it's exactly for that reason that the new legislation affecting sectional title schemes, has provided for a new role called an executive managing agent.
Okay.
And what that role is, it's basically a particular party or service provider that then has the roles and responsibilities of the trustees to then take on that particular decision-making function. So it can be outsourced in that particular way, and typically a service provider with the knowledge, the skills, the time in particular, to do it. And I think it's becoming more and more popular for exactly the reasons that you mentioned. But, in particular, because, it's about time. So many of our trustees and directors, and many across the country playing a role of service in community schemes, are very much time limited, because it tends to be a role that is conducted after hours in personal time. It's unpaid, typically as well. So it really is a service to the community, and not everyone's up for that.
Yes.
Not everyone's comfortable to fulfill this fiduciary responsibility. So in community schemes, it can be outsourced in that way. There are also people that are willing to perform a professional trustee or director service. So for a fee, they would agree to be represented on the board of directors or trustees to fulfill a governance role in the way we're explaining, and that can provide support and capacity to the board to play this particular function. So that's also worth considering if no one is willing or available to play a role. Karine, have you seen these governance challenges and the implications of those over time? And, any comments to add to what I've said?
No, Andrew, I think you covered everything. It is unfortunate that we do not live in utopia, and sometimes things go wrong. That's just life. So we just need to be able to train our trustees and directors to be able to get the correct advice in such circumstances. And that is why there are good managing agents out there that can give advice on things like this.
Yeah. All right. And maybe just, in closing now, just to say that, the other challenge, Yulisa, is that, trustees and directors tend to rotate,
Yes.
because it's unpaid, because it's after hours, because it's overtime. Many trustees and directors, don't serve for many, many years. That would be an exception. So typically 2, 3, 4 years, there's a service element to that. There's a certain pride in, helping to make their community schemes look good and perform well. But, after some time that wears off, and then there's an expectation that the next round of volunteers will step in. So that also creates a challenge, because it's this constant rotation of new role players becoming involved and having to get to grips with new processes, new policies, new formats, etc., which are all unfamiliar at the beginning, and it takes extra time to get to grips with what's happening. And that's why, just to emphasize, it's really important to reach out for help, to not be shy to ask questions. The portfolio team, the accountants, ourselves are all available for input and support, and to answer any questions. Certainly any complicated issues which do arise from time to time will require a dedicated online meeting, and that certainly is preferred to numerous emails backwards and forwards. And a complicated matter is not easy to unpack by email either.
Yes.
So I would suggest an online meeting is convened and scheduled to spend the time to discuss issues, to ask questions of clarity, to work through a particular scenario, and then to agree the next steps, which then can be unfolded thereafter. So, that support is certainly available. And what we started doing as well, certainly for new properties that Trafalgar is taking on to manage, but also for new trustees and directors, we will invite them to monthly webinars, which we are offering. Actually, there'll be online meetings, but just to review important procedures which trustees and directors should be aware of. So, for example, how are invoices for approval submitted? What is expected to approve an invoice? How to work through the standard monthly report, how to understand the information, what are the important information elements to find there, and to be able to track in that way. So those online meetings are going to be available monthly for anyone that's new, that wants to get a better understanding of what procedures are applied, and to be able to ask questions. And anyway, there's an open offer for a dedicated meeting, either individually or collectively with a board of trustees or directors, to go through whatever scenario or whatever report is achieving a concern. And it's really important then that the portfolio team from the managing agent works closely in alignment with the trustees and directors involved, because that just makes it so much more efficient and so much more effective in the way that the operational management and the financial management is actually achieved. So thanks very much, everyone. We've come to the end of our time this evening. So I hope you found that informative. It is a difficult topic. Tax is never a pleasant topic, as you said, Yulisa, but you tried your best. So we appreciate that very much.
Thank you.
Our contact details are on the screen. Please reach out to any of us. We will gladly come back to you on a same-day basis. If there's a complex scenario, we can happily schedule an online meeting and we can talk about it further now or at any time ahead. Just a reminder that the recording and all our prior recordings are on training.trafalgar.co.za. And if you don't mind just completing the short survey to follow, just with any suggestions for other webinar topics you would like us to cover, we would appreciate that very much. I hope you have a good evening. Thank you for your time, and we appreciate you following our training webinar series. Good night, everybody. Bye now.
Thanks. Bye.